Chapter 12, Part 3, What Happens When We Buy Another Company's Stock? And this is when we take into consideration how we account for them. And here the whole issue is not how long we hold them, but what percentage of another company's stock we own. And that determines if we use fair value versus the equity method. Now, when we invest in another company's stock, there are three ways it can be treated, and it's all based on percentage ownership. If we buy less than 20% of another company's stock, then we use the fair value method. We're going to record the dividends as dividend revenue. We're going to ignore the subs, net income, and we're going to adjust to fair value whenever the value changes. Now, however, any adjustments for unrealized gain or losses is part of net income. It does not go to other comprehensive income like it does with debt securities. It goes to the income statement. Now, what happens if we own between 20 to 50%? Then we have to use what's called the equity method. Dividends end up being a reduction in the investment account, and we must record as income a share of the sub's net income. There is no adjustment to fair value unless we elect to use the fair value method. We have a one-time option of doing that, and we can do that. Now, what happens if we own more than 50%? Well, we have to do consolidated financials, which means we have to combine the sub's financials with those of the parents for financial statement reporting purposes. And if you were to look at any major company, you will notice at the top of their financials, they will say consolidated financials. And what that means is they own stock of other companies, and it's more than 50%. In a lot of cases, it's 100%. Now, the subsidiary doesn't do anything different. It's only the person that buys the stock. So here are the guidelines. If it is an equity investment and we lack significant influence, which typically means we own less than 20%, then we're going to use the fair value method, and any adjustments, unrealized holding gains, is going to go to net income. Now, if the investor has significant influence over the operation, they own between 20 and 50%, they have to use the equity method unless they elect to use the fair value option. Again, it would go through net income. And then if we own more than 50%, we have to again do consolidated financials. So, when the investor owns between 20 and 50%, significant influence usually is assumed to exist if the investor owns between 20 and 50% of the investor's voting shares. If more than 50%, the investor has control. What does significant influence mean? They can decide how the company is operated. And they have to use that equity method. Now, greater than 50%, we have to do consolidated financials. The person who buys the stock is the parent. The company that issued the stock is the subsidiary. They are considered a single entity for the parent, not for the sub, only for the parent. Consolidated financials, we combine the individual elements of the parent and the subsidiary statements into a single financial statement. And in these kind of transactions, we can generate what we call goodwill. And this is at the time we buy the stock. Goodwill is defined as the difference on the date of the acquisition between the acquisition price and the sum of the fair value of the acquired net assets. And this is recognized as an asset on the books. Now, we don't cover consolidated financials in this. That's normally covered in advanced accounting. But I would like to say that today, if you work as an accountant, you will more than likely do consolidated financials and deal with the issue of intercompany transactions. Now, our first example. Mike Company purchased 8 million shares of 10% or 10% of Bruce Company for $56 million. The fair value in the net, there was no goodwill. During the year, Bruce Company earned net income of $30 and paid cash dividends of 35 cents per share. Assume that Mike's company does not have significant influence over Bruce. The fair value at the end of the year for the stock is $62 million. Now, date of the purchase, it would be investment in Bruce Company, cash. Receipt of the dividends, it would be cash, dividend revenue. The net income we would ignore from the sub, and we would have to adjust to fair market value, which would be your unrealized holding gain and fair value adjustment. So it's the $62 million minus the $56 that we paid for. Now, what does that look like on the financials? On the income statement, we'd see interest income and the adjustment to fair value. On the balance sheet, we'd see investment in Bruce at 56, plus the adjustment, which gets us up to 62. And on the cash flow statement, it would only appear as part of operating activities. It would be the interest income, and we'd have an outflow for the investment of 56. Now the same problem, but what if instead we had significant influence? Because now we own 30%. At the date of the purchase, nothing changes. We just book the investment. But the rest of it changes. When the subsidiary pays dividends, it is going to reduce our investment account. When we find out the net income of the company, we have to adjust our investment account by increasing it based on our share, but we also have to record that as investment revenue. Seems a little unfair, but that's how it works. Now, adjustment entry to fair value, we don't do that unless we've chosen the fair value option. Now, on the income statement, what does this look like? Other income and expense is investment revenue. On the balance sheet, it would be investment in Bruce minus the dividends plus the net income. And now we have the net value associated with the investment in Bruce account. And on the cash flow statement, we would show operating activities, the dividends, and the investing. And that ends part 3.